Welcome. Today, we're diving into a topic that affects everyone: inflation. You may have heard the term on the news or seen it mentioned in articles, but what does it really mean? Inflation is more than just a buzzword. It's a force that shapes the cost of living, the value of your money, and even your future plans. In this video, we'll break down what inflation is, why it happens, and how it impacts your everyday life. By the end, you'll have a clear understanding of why prices rise and what you can do to protect your finances. Let's start with a simple definition. Inflation is the general increase in prices of goods and services over time. This means that, on average, things cost more today than they did a year ago. When inflation is high, your money doesn't stretch as far as it used to. For example, if a loaf of bread cost $2 last year and $2.10 this year, that's inflation at work. It's not just about one product, though it's about the overall trend of rising prices across the economy. So, how do we measure inflation? Economists use something called the Consumer Price Index, or CPI. The CPI tracks the prices of a basket of common goods and services, like food, housing, and transportation, over time. By comparing the cost of this basket from one year to the next, we can see how much prices have increased. This gives us a percentage, known as the inflation rate. It's a key number that governments and businesses watch closely. But why do prices go up in the first place? There are several reasons. Sometimes it's because the cost of making products increases, like when oil prices rise, making transportation more expensive. Other times, it's because more people want to buy things than there are items available, which pushes prices higher. And sometimes, governments print more money, which can also lead to inflation. Each of these factors can play a role, and often, it's a combination of several at once. Inflation isn't just one thing. There are different types. The two main types are demand pull and cost push inflation. Demand pull happens when demand for goods and services exceeds supply, causing prices to rise. Cost push inflation occurs when the cost of production increases, leading businesses to raise prices. Understanding these types helps us see why inflation can happen in different ways and at different times. Let's look closer at demand pull inflation. Imagine a new smartphone comes out and everyone wants one. If there aren't enough phones for everyone, the price goes up. That's demand pull inflation in action. It often happens when the economy is strong and people have more money to spend. More money chasing the same number of goods leads to higher prices. Now, let's talk about cost push inflation. This happens when the cost of making goods rises. For example, if the price of wheat goes up, bread becomes more expensive. Businesses pass these higher costs on to consumers. Cost push inflation can be triggered by things like higher wages, increased raw material costs, or supply chain disruptions. There's also something called built-in inflation. This type happens when workers expect prices to keep rising, so they ask for higher wages. Businesses then raise prices to cover those higher wages, creating a cycle. Built-in inflation is often driven by expectations and can be hard to break once it starts. Hyperinflation is an extreme form of inflation where prices rise rapidly and uncontrollably. It's rare, but when it happens, money can lose its value almost overnight. Historical examples include Zimbabwe in the 2000s and Germany in the 1920s. In these cases, people needed wheelbarrows of cash just to buy basic items. Hyperinflation can devastate economies and people's savings. On the flip side, there's deflation, which is when prices fall over time. While it might sound good, deflation can actually hurt the economy. People may delay purchases, expecting prices to drop further, which slows down economic growth. Businesses make less money, leading to layoffs and even lower demand. So, a little inflation is usually better than deflation. Stagflation is a tricky situation where inflation is high, but economic growth is slow and unemployment is rising. This combination makes it hard for policymakers to fix the problem. If they try to slow inflation, they might make unemployment worse. If they try to boost growth, inflation could get even higher. Stagflation is rare, but challenging when it occurs. Now, let's get personal. How does inflation affect your daily life? The most obvious impact is that your money doesn't buy as much as it used to. Groceries, gas, and rent all become more expensive. If your income doesn't keep up with rising prices, you might have to cut back on spending or change your lifestyle. Inflation can also affect your savings and investments, making it harder to plan for the future. Purchasing power is a key concept when talking about inflation. It refers to how much you can buy with a certain amount of money. As prices rise, your purchasing power falls. For example, if you could buy 10 apples for $5 last year, but only 8 apples this year, your purchasing power has decreased. This is why inflation matters to everyone, not just economists. Inflation doesn't just affect what you buy today, it also impacts your savings. If you keep money in a savings account with a low interest rate, inflation can eat away at its value over time. For example, if inflation is 3% but your savings only earn 1%, you're actually losing purchasing power. That's why it's important to consider inflation when planning for the future. Wages are another important piece of the puzzle. If your salary doesn't increase as fast as inflation, you might feel like you're falling behind, even if you're earning more in dollars. That's why many workers negotiate for cost of living raises to keep up with rising prices. Employers and governments often look at inflation when setting wage policies. Inflation can also affect people with debt. If you have a fixed-rate loan, like a mortgage, inflation can actually help you. That's because you pay back your loan with money that's worth less than when you borrowed it. However, if interest rates rise with inflation, new loans can become more expensive. It's a double-edged sword. Investments can be a way to protect yourself from inflation. Stocks, real estate, and certain commodities often rise in value when prices go up. However, not all investments keep pace with inflation, so it's important to diversify. Understanding how inflation affects different assets can help you make smarter choices with your money. Planning for retirement means thinking about inflation. Over decades, even low inflation can erode the value of your savings. That's why retirement plans often include investments that are expected to grow faster than inflation. If you don't account for rising prices, you might find your retirement income doesn't go as far as you hoped. People on fixed incomes, like retirees, are especially vulnerable to inflation. If your income stays the same, but prices rise, you can afford less over time. That's why some pensions and government benefits are adjusted for inflation to help people keep up with the cost of living. Not everyone loses from inflation. Borrowers with fixed-rate loans can benefit since they repay their debts with money that's worth less. Businesses that can raise prices faster than their costs increase may also do well. However, most people need to be careful, as inflation can quickly outpace income and savings. On the other hand, savers and people with fixed incomes often lose out. Their money buys less as prices rise, and they may struggle to keep up. Inflation can also hurt people whose wages don't increase as fast as the cost of living. That's why it's important to understand inflation and plan ahead. Governments and central banks play a big role in managing inflation. They use tools like interest rates and money supply to try to keep inflation at a healthy level. If inflation gets too high, they might raise interest rates to slow down spending. If it's too low, they might lower rates to encourage borrowing and investment. Central banks, like the Federal Reserve in the US, are responsible for keeping inflation in check. They set policies to target a specific inflation rate, usually around 2%. By adjusting interest rates and other tools, they try to keep the economy stable and prices predictable. Interest rates are a key tool for controlling inflation. When rates go up, borrowing becomes more expensive, which can slow down spending and reduce inflation. When rates go down, borrowing is cheaper, which can boost spending and raise inflation. Central banks adjust rates based on what's happening in the economy. Most central banks aim for a moderate level of inflation, usually around 2%. This helps keep the economy growing without letting prices get out of control. Too much inflation can be harmful, but too little can also cause problems. That's why central banks work hard to hit their targets. Inflation is closely tied to the overall health of the economy. A little inflation is usually a sign of growth, but too much can signal trouble. Economists watch inflation rates to gauge how the economy is doing and to make predictions about the future. Inflation isn't just a local issue, it's a global one. Events in one country can affect prices around the world. For example, a drought in one region can raise food prices everywhere. Global supply chains mean that inflation can spread quickly across borders. In recent years, many countries have experienced higher inflation due to factors like supply chain disruptions, increased demand, and rising energy costs. These trends have made inflation a hot topic in the news and a concern for policymakers and families alike. Technology can both increase and decrease inflation. On one hand, new tech can make production cheaper, lowering prices. On the other, it can create new demand for products, pushing prices up. The overall effect depends on how technology changes the way we live and work. Inflation shows up in everyday life, in many ways. You might notice your grocery bill is higher, or that your favorite restaurant has raised prices. Even small increases add up over time, affecting your budget and spending habits. Being aware of inflation helps you make better choices with your money. One way to deal with inflation is to adjust your budget, track your expenses, and look for areas where you can cut back if prices rise. Planning ahead can help you stay on top of your finances even when the cost of living goes up. Inflation makes it more important than ever to shop smart. Look for sales, compare prices, and consider buying in bulk to save money. Small changes in your shopping habits can help offset the impact of rising prices. If inflation is high, it might be time to negotiate a raise at work. Make sure your income keeps up with the cost of living, research average salaries in your field, and be prepared to explain why you deserve a raise. Investing is one of the best ways to protect your money from inflation. Consider assets like stocks, real estate, or inflation-protected bonds. Diversifying your investments can help you stay ahead of rising prices and secure your financial future. Some investments are designed to protect against inflation. For example, Treasury inflation-protected securities, TIPS, in the US, increase in value as inflation rises. These can be a good option if you're worried about your savings losing value. Inflation can also affect your taxes. As prices rise, you might move into a higher tax bracket even if your real income hasn't increased. Some governments adjust tax brackets for inflation, but not all do. It's important to understand how inflation could impact your tax bill. Many social programs, like Social Security, are adjusted for inflation. This helps recipients keep up with the cost of living. However, not all programs are indexed, so it's important to know how your benefits might change over time. Housing costs are a big part of inflation. When prices rise, rent and home prices often go up too. This can make it harder to afford a place to live, especially for first-time buyers or renters. Keeping an eye on housing trends is important for your budget. Food prices are often one of the first places people notice inflation. When the cost of ingredients, transportation, or labor goes up, so do grocery bills. Planning meals and shopping smart can help you manage these rising costs. Transportation costs, like gas and public transit, are also affected by inflation. When oil prices rise, it costs more to get around. This can impact your daily commute and travel plans, so it's important to factor these costs into your budget. Healthcare costs are another area where inflation can hit hard. Medical bills, insurance premiums, and prescription prices often rise faster than other expenses. Planning for healthcare costs is an important part of managing your finances in an inflationary environment. Education costs, like tuition and supplies, often rise faster than general inflation. This makes it important for students and families to plan ahead and look for scholarships or financial aid to help cover the costs. There are steps you can take to protect yourself from inflation. Invest wisely, keep your skills up to date to earn higher wages, and budget carefully. Staying informed and proactive can help you weather the impact of rising prices. To sum up, inflation is the rise in prices over time, affecting everything from your grocery bill to your retirement savings. Understanding how inflation works and how it impacts your money is key to making smart financial decisions. By staying informed and planning ahead, you can protect your finances and make the most of your money no matter what the economy brings. As we look to the future, inflation will continue to play a role in our lives. By understanding what drives inflation and how to respond, you can stay ahead of rising prices and secure your financial well-being. Remember, knowledge is power, especially when it comes to your money.